events in Iran and how they're going to affect your portfolio. So the reality is, I'm obviously not a soothsayer, but but the truth is, I've been working in the humanitarian aid field for over 22 years. It is what I did as a lawyer. I worked in human rights and human right policy for many years across the Middle East and North Africa. So this is actually an area of policy that I understand very well. And of course, as a trader, I can pull probably the two worlds together in a unique way than others who are trading in the space. Now, a lot of people will look back at historical data. They'll look back at what happened in the Gulf War, in the invasion of Iraq, Afghanistan, and then even this 4-year war with Ukraine, and then see what has happened, what has transpired. But the reality is that the US stock market is exceedingly resilient. And the volatility inside the market is really based on what we don't know could potentially happen or possibly happen. Now, everyone has been expecting this escalation. And the reality is that we actually haven't, this isn't a new situation. We have actually been at war with Iran for a very long time, and so has Israel. And so the reality of the situation is that this isn't a new situation that we're dealing with. It's that we have decided in this war that we will have longer periods of non-aggression that make it seem like the events have stopped and something new has been instigated. But the market doesn't see it like that, because the market sees that whatever created the first set of instability was never truly resolved. And so the underlying thesis of why there is conflict will continue to carry on. However, we have just seen the market over the last 6 months come to basically a standstill, except for, like 𝐷𝐸𝐴𝐵𝐷𝐸𝐴 or whatever they call it, the whole kind of like software crash that we've been experiencing. That is a very like singular aspect of the market, and that has a lot to do with AI and the fact that it is still really unknown how much AI could potentially disrupt the software and cybersecurity sector. Now, of course, there's a lot of back and forth in that space, and so there's a lot going on in that area. And so we don't want to dismiss that. We don't want to pretend that markets aren't impacted by that data or what's going on. But that obviously doesn't have anything to do with what has been going on with Iran. Now, the reality is that over the last 7 months, we have seen Israel invade almost all of its neighbors: Syria, Lebanon, parts of the Palestinian Area Authority. And of course, we have now, and we saw its aggression on Iran previously. So whatever your politics is kind of irrelevant. The reality is that this situation hasn't been going on just today. It is an ongoing situation that has had waves. Now, how Americans are experiencing the news is unique because Americans don't care that much about the political sensitivities of what's happening in Syria or what's happening in Lebanon or what's happening in Iran or what's happening in ABCD, because that part of the world tends to be dealt with as a monolith, that's the Middle East, that as Arabs, we don't get to be individual people with individual ideas. It's kind of like when people talk about Africans as if South Africans, Cameroonians, and Algerians share anything in common. Literally, a Brazilian and a Canadian share more in common than an Algerian and a South American. But because we've just called it Africa for so long, it has meant something, even though actually it really doesn't mean anything except for a geological space. But that's what happens in society, right? Like we give words meaning and then we create meaning even when it doesn't even exist. So, Arabs have also faced that reality because, first of all, most people who live in the Middle East, they are not all the same ethnic group and they don't share all the same religion. And even between Muslims, there is a great diversity in what and how they believe and their school of thoughts. Just like if I put a Catholic, an Orthodox, a Serbian Orthodox, a Roman Catholic, an evangelical Assembly of God member, and a Brazilian Pentecostal all in the same room, I think that actually they probably share a lot less in common than you may actually think, right? Like I could probably find 10 Brazilians that agree more with each other just because they're Brazilian, or 10 people from Alabama that agree more with each other because of the fact that they're from Alabama, more so than like their religious congruency actually impacts what they believe in kind of straight lines. Now the question is, how does this impact the market? So first of all, is the market surprised by what happened? I don't think it was surprised. I don't know why it would be surprised. We have been talking about this for weeks. The market's probably more surprised by the very ridiculous and stupid name that Trump gave this little escapade, whatever, epic fury, like Talladega Nights. I mean, it's like, really, did SNL write this script for you guys? And SNL probably could, because at this point, like, Trump can kind of do whatever he wants. And like, we're all so much embedded in this like dog and pony show that at this point, like, I don't think anybody knows what to do next. And like the excitement of it, or just the like constantness of it, makes it almost like impossible to even, you can't react anymore. You just have to be like numb to the ongoing situation. And so the key thing to remember is that volatility really picks up when something surprising happens. I think markets would react very negatively if the US had invaded China, or if the US had invaded Canada. But I think what went on with Venezuela, what went on with Cuba, what's going on in Iran, none of that is a surprise to markets. I think that just the ongoing desire for pushing war in Iran has been an ongoing conversation. And I think that the reality is that it's become very clear that Israel has a significant influence in US policy, and they have been wanting to have an aggression with Iran for more than 20, 30 years, right? So I think that it would have been strange for the markets to suddenly react to this as if they didn't see it coming. The market saw this coming. They've already seen it coming. The markets have been participating in all of this. Now, there are aspects of how this aggression might intensify that we don't know. And so that really will be very specifically focused on energy and energy costs and oil and gas transportation and services. So that very specific sector could have a lot of volatility. But the reality is that energy isn't at all in the NASDAQ. And because literally it is tech and tech related sectors, sans energy and financials. So the NASDAQ doesn't have any kind of direct impact by what's going on with energy. Of course, they're like knock-on effects, but it's not a direct correlation. And the S&P, the XLE represents like the tiniest percentage. So now what could happen is that because of the fact that tech and consumer discretionary and those areas have so significantly underperformed the last 6 months, and if they continue to underperform, but then suddenly staples, industrials, and energy also start to underperform, then this could give us a push down. The reality is that the market needs to pick a direction. Like the S&P has literally been doing a non-price discovery for the last 6 months, and it's been doing a bunch of sector rotation. So, and the rotation has been into energy, which a lot of people have been exposed to. So I think that it's no surprise that the last 6 months, everyone has talked about get involved in energy, get involved in commodities, gold, silver, copper. What I mean, like we're even doing like agriculture. I mean, like we're so deep now into like what aspects of commodities we can be exposed to or be long to. So I think that everybody's kind of already in that bet. If you're not in that bet, I think you are going to be a bit late to the party, because even if we get a immediate reaction off of this situation, the question is how long is that going to last? Listen, countries like the Emirates and Saudi and like the whole GCC region, the Gulf cooperation countries, their entire economies are heavily leaned towards energy stability. And so whether they like it or not, they're going to try and do whatever is possible to, whether aggressions continue, they will do what is required of them to calm and to smooth out volatility in this area of the market, because it doesn't serve them to make people nervous and then do radical things with how much energy they want to store, how much they want to transport. Keeping things as status quo as possible is what keeps the prices as efficient. And that's the best for both sides of the supply chain. So I think that we're going to see some like calmer minds come to the table to be able to like smooth out this situation because nobody wants to see unnecessary frustration in like the basis of their economy. So there's that. Then the reality is that when you look back at the historical data of war, usually you might get a 5 to 7% pullback in the market, which right now would be a huge blessing because the markets have just been doing nothing for so long. It would actually allow us to reposition ourselves in wider areas of the market. But when you look after 12 months later, markets are up between 12 and 10 and 12, even 14%. So this is not a time to panic. I think a lot of people have been sitting on quite a bit of cash because of the non-performance of the market, the fact that we haven't had significant pullbacks, the fact that we haven't had really good re-entries into really long duration plays. All of that has like encouraged people to sit on some cash, both to be able to manage positions they're in, but also to be able to take advantage of a deep pullback because some people feel like they didn't get active enough back in April during the tariff tantrum, nor did they get active enough during the 2023 pullback, nor did they get active enough after COVID. So people are just realizing that the markets are really resilient. And even though you might have to put up with a couple months of frustration, overall, like you're not going to remember this event. And I mean, you can see it in the wider conversation because even when you talk to people about the war in Iraq or the first Gulf War, or even like what happened in Afghanistan, just the like general population has moved so much from that particular era that the people who are deeply participating in markets right now, they're either passive funds that just don't care at all about geopolitics. So this isn't impacting like if they are investing in the S&P and if they're investing in the wider market. And those who are young enough to have seen how fast the market can recover, they're not going to care if there's a pullback. Their first intention is, I'm so young, I need to take advantage of every pullback because anybody that's been trading just these markets in the last 3 years or 4 years, like you've literally watched the S&P double in value. And that's not normal. Like our parents didn't see that. I never saw that until now. I mean, obviously over 20 years, yes, over 10 years, you expect markets to double because you're getting that average 10% a year. That's normal, but you're not expecting in 3 or 4 years to see the entire US stock market double in value. That's a little bit like, wow. But for, like my siblings' generation and younger, that's like something that is normal for them. For them, they're able to conceive the speed up in productivity, the speed up in AI, the value of AI in different parts of businesses that were really high capex and now allowing operational expenses to come down. So their whole kind of mindset and worldview is going to be buy the dip. And so between passive funds, between the buy the dip, like hardcore committed members of society, there is really only a very narrow portion of market participants that are like going to freak out and then respond by selling everything. And those people aren't enough to really move the markets. Because really, when you think about market participants, the other level of institutional investment, most of what they're doing is already hedging. So they may actually be taking a lot of profits on the hedges that they've already had put in based on their regulatory environment. So, they are going to be participating in this whole event in a completely different way than, normal people because they already had rules and regulations that required them to hedge on tail risk, to hedge for volatility, to diversify over time. Listen, if you have a rule that like 20% of your long portfolio must be invested in the stock market for at least 20 years, and that percentage is only 6 months into its investment, you're not even going to be looking at how do I need to reposition that, because your bylaws state that needs to have a 20-year horizon. And so you're going to stick with that. There are very few people, even institutions, that their entire book is being rotated every single day. I think the only people who participate in that madness is Cathie Woods at ARK. And, we saw how her portfolios did over the year and how much money she burnt up for people. Now, of course, some of her portfolios are doing better because of the AI revolution. But overall, I mean, her lack of performance is in part because she exposes every trade that she makes every single day, but also that somehow they marry a day trading conspiracy kind of action with like a 50-year time horizon and what could happen. So Bitcoin to 1 million, but they're buying and selling Bitcoin all the time. But they're like buying the highs and selling the lows, which never really seems to make sense. But no one's asking them for their performance portfolio because we know Cathie Woods' performance is, yeah, nothing to get too excited about when you look over the last 5 years of performance. But, most hedge funds, most money managers aren't Cathie Woods enthusiasts. They're not trying to participate in that kind of bizarre day trading activity with billions of dollars. So I think that, we have to look at the markets as they are. And the biggest players are institutional investors, money managers, money market funds, and they have really strict rules, a lot with passive investing. And then, this younger up and coming generation that is hardcore by the dip hold. And then it's just a really narrow, very small window of personalities that are like me and you, where we like want to have the power to day trade. We want to have the power to manage our accounts. But then the most important thing is to remember, like, what are other people doing? And like, are we participating in an overall bullish market, or are we scaring ourselves and then getting out of positions too early? So if you're in shares and you don't have anything to, if you're in shares, I would say utilize, if we do get the 5 to 7% cut, then you need to be like, organizing yourself to get back, maybe do some dollar cost averaging. But I would really be looking more at selling short puts. The volatility will be high, so the value of those short positions will be brilliant. And you'll be able to get your position so far away from the current price that even if you were to get like a really like fast tap down, the money you would make on the pop back up would just be exponential, and that would help you not feel the kind of strength of the pullback in your share positions, depending on from how long ago you've been dollar cost averaging. Because I promise you, people who've been dollar cost averaging into like the mega cap stock for 10 years plus, they genuinely won't care at all if they get a 5% pullback from here, because it doesn't make sense in like how far they've come. But if you've only been investing for 6 months or 1 year or 2 years, you might feel stressed out, and I can understand that. Then you do need to consider other ways of generating income against your shares. So, and taking advantage of this very high VIX. Then on the other side is that you might not get that big of a move on this event, and you might not get a move that is sustained over many, many, many weeks, or even many, many, many months. So, you don't want to like overreact and then end up demolishing your account in such a way that that doesn't benefit you over the long run. And I do think that, the politics is always going to be, there's always going to be negative conversations about that part of the world. And for those of us who have friends and family that live there, this is, very stressful time for us. I mean, I've spent like the last day on the phone calling my friends and family to make sure that they're okay and that everything is fine, and, getting lots of WhatsApp messages with people showing me, you know, what's going on in like where they live and near their homes is, you know, but we've also lived through this, right? Like, I mean, I was in 𝐼𝐸 doing when I was working like at the height of the last Gulf War. So, you know, like we are also, I don't want to say desensitized, but there's just a reality that like we've seen this and we've somehow survived it all of these years. And so maybe it makes us have a less, uh, like a more may our reaction to the situation is different because we don't have control and we know that like that is where we are, that is where we're from, that is part of our life. So for you know, I don't want to minimize the stress and pain and sadness that these families are facing, especially those who have lost loved ones unnecessarily, on all the sides, because you know war is can be cruel, and war is cruel and you know impacts so many people. So I don't want to belittle what's going on and what people are facing because like I've been there for most of the years of my life, and so I don't wish that upon anyone. But as traders, there is kind of a mindset you have to keep about how this is going to impact your funds, your portfolio. And for those who listen to me and take my thoughts to heart, I do want to give you guys just the, you know, I want to give you guys the reality and the logics and the pragmatic aspect of what the markets will do, not just passing through like the emotional sadness of what is going on, because it is very devastating to the families that are facing this situation, are going to have to live through the results of this over the coming years. But the reality is that this focus on Iran, it didn't happen today. And it's been going on for many months, and the focus and drive towards regime change in Iran, just like in Venezuela and just like in Cuba and just like in that this has been part of policy for a very long time. No one woke up on Saturday and said, "Wow, what's going on?" Right? It's not like if suddenly we invaded Vietnam. I don't think anybody's expecting us to invade Vietnam or to invade Italy. Like, you know, I don't think that's on the agenda anywhere. And that would shock people and shock the markets. But this has kind of been the status quo for so long that the markets just don't care anymore. Sorry to say. And I think that volatility in the market is going to demonstrate that much faster than we may anticipate if you're expecting this to be a long, drawn out 25, 30 handle VIX. I don't see that being the reality. Now, events on Monday could demonstrate something else, right? Like the aggression could intensify, things could change, things could escalate aggressively. We could draw in other countries, then all hands are off, right? Like then my thesis changes because the situation will have changed very dramatically. But I don't think the GCC countries are that interested in all of this. They want to keep the Strait of Hormuz, you know, running smoothly. They want energy and gas to be able to move without stress and without hiccups along the way. They want things to run as smoothly, status quo as possible. And we already saw with the Yemen situation when Yemen was blockading all of the different ships coming through the Gulf. They also, you know, there were some hiccups and costs of transportation increased, but the markets absorbed that volatility quite nicely and very quickly, and then things straightened themselves out, you know, in a relatively short amount of time. And the truth is that any costs that those delays were going to create were going to be so far off for the companies to have to absorb, and insurance costs and so forth, that actually, even though that could have like created a lot of costs, there was enough time between the impact of the event and the cost increase that companies were able to figure out ways to manage and absorb those costs. But then because events in Yemen ended so quickly, companies didn't have to be that concerned over the long duration of time. So really the main thing about cost will be if some kind of aggression were to be intense and then keep its intensity high for a longer duration of time, which then could cost new cost impacts that people aren't considering right now. But that's not going to be like the first instance situation that you need to be concerned about. So good luck out there, friends. I hope that this helps you kind of keep the emotions in check while you're deciding what you want to do on Monday morning regarding your portfolio. And again, I'm not a financial advisor, so these are just my thoughts because this is an area that I've worked in for a really long time, and I've just seen how the markets react or really don't react that significantly in these situations. I think that probably the situation between Russia and Ukraine was one of the times that we had a much longer kind of impact in the markets. And that was really focused on the situation of LNG and the situation of fertilizer. So there was a bigger impact on commodities during that situation, but even that didn't last very long. And a lot of the cost fears were significant overreactions once the entire situation was kind of assessed. And then, plans were created moving forward for any potential loss of access to LNG in the western part of Europe. So, it was all the reaction was too strong. So hopefully that gives you a bit of confidence to at least say, you know what, let me just keep my mood flat and then make decisions regarding my portfolio like an institutional investor and not just let all of my concerns and worries kind of frustrate all the hard work I've done over the last 1, 2, 3, 4 years, however long you've been actively trading. All right, friends, I hope you have a great day and good luck in the markets tomorrow. Bye for now.